Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. New York coffee. I have said this many times over recent months, but the pipe tops formed on the 9th and 12th of September last year were the direct triggers for the move lower that we saw until January this year. The actual pattern set up for the move lower, the lopsided diamond pattern, seen disappearing in the top left of my daily chart and highlighted in dark blue, is huge. I've previously given a primary target of this in the 166 3/4 area, with a secondary harder to achieve target X1 in the 142.40 area. The primary target was achieved in early November and the harder to reach secondary target X1. Well, we came awfully close in early January, but the congestion around the 2019 high at 142.45 and a September 2017 high at 143.35 proved to be too much for this attempt lower. We dodged it, but only just. Nevertheless, for the moment, I'm still calling it live, at least for now. I said back then when indicating these targets many months ago, and I quote, "There is one other fly in the ointment. Perhaps, just perhaps, this lopsided diamond pattern is becoming a big bear channel. If that is to be the case, then the first area to look at below would be the lower bear channel line of such a pattern. That's currently at 153.05, end of quote. The extension of the bear channel is highlighted in bright green on my daily chart. And the lower bear channel line has played a significant part in recent attempts lower, until January saw a reactionary rise that followed on into February. Interestingly, prices halted their rise in late February as they came a little too close to the upper bear channel line, currently 191.30, which has a close wingman dynamic resistance in the form of the declining long moving average, currently at 190.20. The pullback lower since then has halted more or less at the nearby 50% Fibonacci line of the May 2019 to February 2022 move at 174 even, which I've highlighted in purple on my daily chart. Now, I have on many recent occasions discussed in wide terms how the overall action, the drop and sideways action, even the pullback up in late February and subsequent sideways action may be making a very large descending scallop pattern. I reinforced this idea after looking at London coffee, where this seemed and still seems to be a more reasonable idea. I still hold to this idea, which may surprise you, but I'll explain why shortly. Though the fall since the start of this year was in line with the bearish move of a descending scallop, including my laying out a primary target X in the 128.5 zone, and a secondary harder to reach target, a much harder to reach secondary target X2 way down in the 78.5 zone, and off the bottom of my daily chart until, well, even now. Despite laying out these targets, I still hold to the idea of a possible descending scallop pattern, as this pattern, as I said a few weeks ago, and I quote, can also have an upward element. But it is an important but it will depend on what the market does should it get to the key 50% Fibonacci line of the May 2019 to February 2022 move at 174 even. For the moment, I will leave the targets where they are below, but they could easily be retired on confirmed moves higher over the 50% Fibonacci line. I can't keep reiterating that 174 line. Anyway, that was the end of that quote. I'm ready to retire the downside targets here and even lay out some topside targets for a possible descending scallop pattern. But, and again, it is another important but I still wish to see just what the market wishes to do in this 174 even area. London coffee. I've said here now many times that the lower time, currently at 16.45, of the late December 2021 to mid-July 2022 bearish Andrews pitchfork, which I've conveniently highlighted in dark blue on my daily chart, was where the rally started back in mid-November last year that seemingly peaked just over the upper time at the end of February. The upper time is currently at 20.99 and into the start of March, but may have possibly started to advance higher again with a possible new pattern. Now, before I delve into that new pattern idea, I'd like to revisit my commentary from 14 weeks ago, when I put forward then a new suggestion, idea of what may be happening. You see, looking here at the London contract and a little also at the New York contract, I suspected at the time that the action since mid-October may be a descending scallop pattern, sometimes called a backward letter J pattern. Here on the London contract, and especially on this London contract, this pattern had merit. A few weeks ago I laid out here potential topside targets. They were then both above, as prices then seemed to be willing to go that way. Okay, so a primary target was in the 2095 area with a much harder to reach potential topside secondary target X1 in the 2280 area, where the 2017 high is. The primary target was reached in February and even exceeded somewhat. Prices peaked over the upper time, as well as the August and June 2017 highs at 2173 and 2175 respectively, into early March. Yet they did not manage to hold up there. The question I laid out 3 weeks ago was whether the move above the upper time, whether this was a break higher or still just an extended breach. Back then it seemed to me that the overall movement was still higher, and that was why target X1 at 2280 was still live back then. However, since then, falling prices in mid-March made me question that idea, such that in mid-March I laid out potential targets on the downside of this very large descending scallop pattern, just in case. Thus we had target X2 in the 1812 zone and target X3 in the 1662 zone. I will leave these on for one more week, but I am looking to retire them next week. Thus we come to the action formed over the whole of 2023, and a certain pattern may be emerging. It's not wholly clear, but we could be seeing maybe one of two patterns coming. Either a topping action in a possible form of a diamond pattern, or a possible bullish halfway hesitation. This latter one would be a very strong bullish indication, way up off the top of my daily chart. So for the moment I'll hold my peace on that one and wait and see how it develops. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.